Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 305th podcast VideoCast for the week ending August 21st, 2025. As always, we'll start with family first, and then we'll get down to business. A lot of great stuff to cover this week. We'll try to keep it under, I can't promise we'll keep it under an hour, but we're going to try to, because next week we're going to have a tremendous amount of media. We'll be on Clayman Countdown on Monday. We will be on the Big Money Show for the full 2 hours. All these are Fox Business, by the way. Full 2 hours on Tuesday. We will be on Varney on Wednesday morning on Fox Business. Potentially Charles Payne on Thursday, not confirmed. Yahoo Finance on Thursday afternoon at 3 p.m. And Yahoo Finance with Kenny Polcari at 1 p.m. on Monday, and BBC on 10:30 a.m. So we're going to have a lot of media next week. So this week, we'll try to go easy on you. This was Annabelle, her first day at school this Monday. So pretty excited for her. That's us having breakfast on Saturday. Caitlin, Mimi, and Annabelle. We had a fun time, and so on. So not a whole lot to go into. For those of you who have been voting for Annabelle at the Athlete of the Year, just remember, all the votes are free. You don't have to donate anything. So it's a long process. So if you get emails to vote and you feel like voting and you think she deserves to win, please do so. Just do the free stuff. And I think this thing goes for another few weeks, but every time you get a chance to vote for free, please do so. And that'll be awesome for her. And then moving along onto the media, had the pleasure to join Ash Webster on Varney & Co. Fox Business on Friday, talking a little BABA and a lot more. Thanks to Peyton Jennings and Christian Dagger for having me on. We'll listen in here.
Down even further, look at some of these stocks. And let's begin with United Health and Nucor, both heading higher this morning, as you can see nicely. Berkshire Hathaway disclosed major investments into both companies while pairing Apple stock. So there you go. Look at United Health up 10%. Thomas Hayes is with me this morning to talk about this. Good morning to you, Thomas. Do you follow Warren Buffett and Berkshire Hathaway moves? I mean, certainly the market seems to.
Very, very closely. My whole business is predicated on the philosophy that what Warren Buffett once said, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock price to be misappraised. United Healthcare is the perfect example of that. This is one of the greatest healthcare insurance companies in history. The stock was down 61% peak to trough this year on the DOJ investigation into Medicare billing and increased loss ratio. He swooped in and bought it in the hole while everyone was puking out the stock in uncertainty. Warren Buffett and his team bought it. That's what's made him the greatest of all time and will continue to make him the greatest of all time. As it relates to Nucor, Buffett historically likes competition, businesses that have no competition. And with 50% steel tariffs and the massive reshoring happening in the United States, Nucor is well positioned due to that. And Warren Buffett said, I'd like some of that.
All right. Well, let's move on. I want to talk about Intel. A lot being talked about this chip maker. Another good day for the, well, let's call it the bewildered chip maker. It's up 2.5% after yesterday's 7% gain. A new report says the Trump administration is considering taking a stake in the company, which in itself is fascinating. Intel is one of your stock picks. Why do you like Intel that has been struggling?
We love it. We gave it to Stu at $20. It sat there forever. It's now starting to go. If the government actually steps in like a wartime policy, a competitive policy, the Ohio chip plant for fabs could be one of the largest chip making plants in the world. And you know why we bought it? It's the only game in town. If you're serious about building chips in the United States, they're at the 10-yard line. They do need some government help to push it over the edge. But Lip Bhutan, who came from Cadence Systems, is a winner. He did a turnaround at Cadence. The stock was down 85%, 68 bagger over the next 14 years. This guy knows how to turn around companies. He went to meet with President Trump.
Yep.
If they're investing side by side with Lip-Bu-Tan, they're going to have a huge win for Intel, huge win for the United States, and make us less dependent. And by the way, there was an announcement that he's considering tariffs, 300% tariffs on chips coming in. How's that going to set up Intel moving forward? It's going to be a monopoly for Intel if they get this done correctly.
Very good. All right, let's move on to another well-known name, Meta. A new report from Reuters is calling out the company over their AI chatbots. They say internal documents show that Meta allowed their chatbots to engage in romantic conversations with children. Are you kidding me? Republican Senators Hawley and Blackburn are now calling for a congressional probe over that accusation. This is a weird one. Meta itself up 0.5%. What's your take on all of that?
I think Meta's got to get on it. We're going to see all kinds of unintended consequences from AI, but also all kinds of unintended benefits from AI. But the consequences and the negatives, you can't have inappropriate talk with minors. That needs to be nipped in the bud very, very quickly. It's good to see the senators taking action right away to get ahead of it. You know, with social, maybe they were a little behind the curve. With AI, hopefully they can stay ahead of the curve. This is a good development. It will be good for Meta. It will be good for the kids. It'll be good for creating a framework for this new technology.
Exactly. All right, moving on to the semiconductor equipment maker, Applied Materials, down 12, nearly 13% after their third quarter earnings. Their forecast for the current quarter came in a little lighter than expected, and CEO Gary Dickerson says that the macro environment is, quote, creating increased uncertainty and lower visibility. You know, what do you make of that? Any worry for these stocks?
Well, he did the absolute no-no, which is he took down guidance. The average company that beat and raised this quarter was up 4.5%. The average company that took down guidance was down over 10%. Applied Materials is no different. They were complaining about tariffs. They were complaining about export licenses. Newsflash, everyone else in your sector has the same problems, and they're doing just fine, so get your act together.
All right. Tough love. Let's take a look at Target. Headed south, down ever so slightly, nearly 0.5% after a downgrade from Bank of America. Analysts say the retailer is falling behind its peers, namely Amazon and Walmart. They say Target's outlook is, quote, deteriorating, which is not good. So can Target catch up to Walmart and Amazon? What's your take on this, or is it too late?
Look, the sell side is famous for downgrading in the hole. This stock is down a lot off of its all-time highs. I think this is an area where you want to start to look at it. It's a high-quality business. My 11-year-old and 13-year-old daughters can't get enough of Target. They love it. They say they have everything they need all the time. Even I've gone to the store and I said, this is pretty cool. So look, at these levels, I want to start to take a look at this. This is a high-quality, durable business that's proved its way over time. And they'll get it right. Whether it goes a little lower before it starts to recover is unknown. But I think for the long term, you probably start to be okay at these levels.
I want to get to another of your stock picks, Tom. We had another analyst earlier this week bring us the same stock. There has to be something to it. Albemarle.
Okay, well, Ash, I brought this to Stu on June 18th. Wow. It's up close to 50%
Bravo.
Since. And by the way, it's going to double again from here over the next few years, in our opinion. Here's why. The Chinese government is taking out overcapacity. They did not renew a license for CATL to continue its lithium mining. So they're starting to take supply off the market. Albemarle is one of the lowest cost producers in the world. They're cyclically positioned perfectly. They've got $3.1 billion of liquidity, and demand for lithium is going from 1.2 million metric tons to 3.2 million by 2030. And that's not just Chinese EVs.
Right.
That's energy battery storage systems.
We hear
they
what
are
you're
the player.
saying,
They're going to benefit.
We hear you. You're very optimistic. Thank you. Great stuff. Thomas Hayes today. Thank you very much. Coming up, a whistleblower.
And we're back. Then I want to thank Johan Cherian and Sanchayita Roy for having me in their Reuters article. And then quote of the week from the greatest of all time, Warren Buffett: the stock market is a device for transferring money from the impatient to the patient. no better example this week than Cooper Standard, that were transferring us all of their shares in 2022 at $5, and then we got some more at $3 and change, and we got some more at $7, and got that initial basis around $5. And now it just got upgraded for the first time by Stiefel with a buy rating, price target $39. So here we are, 5x later, and almost 6x probably by the end of the week, and just getting started. So, but who, nowadays, who could be in a stock for 3 years to get 500% gains? And the answer is very few people. And the problem is you don't get 500% gains without patience. So we just learn from the master, and we try to communicate those philosophies and framework with you each week. And for those of you who are avid listeners, the way we continue to do this in perpetuity is by sharing and growing. If we continue to grow, we're going to continue to do this and come here and leave it all on the field every single week. And one of the ways we do it is we have merch with the merch store, and it's not for the $7 or $8 we make on a hat. It's so that you wear it and people ask you about the incredible hat and what's that all about. So the best compliment you could always pay us, certainly wear your merch. And secondly is share the podcast with one person each week that you care about, that loves markets, that you think could benefit. And this week we had a bunch of people send in their pictures. We got way more people that have ordered merchandise than have sent in pictures. Send it to info@hedgefundtips.com. We'll get you on the site, and you can see some of your community members here that had the courage to send in a picture, get on the site. This week, Kathleen Gherkin sent in a picture, so super excited. It just goes on and on and on. There's Statman, my buddy that teaches over at Westminster, and his great students. So moving along, we got the data. Let's get down to some data here. And first and foremost, it's interesting, earnings weight versus sector weight over time. And this is just another way to think about what we always say. In the short term, the market's a voting machine based on emotion. Long term, it's a weighing machine based on fundamentals. And you can see here they've got healthcare plus consumer staples plus utilities. These are defensives. And you can see that by and large, the weighting of the sector follows the earnings growth over time. And when there are big divergences between earnings growth and weighting in the S&P, what you find is opportunity. And right now what we're seeing is a big divergence, because short-term voting, long-term weighing eventually converges, is the point that I'm making. Right now the biggest divergence is in Mag 7 has such a disproportionate percentage of the weighting in the S&P relative to the percentage of net income of the S&P, i.e. earnings power. And we're seeing signs of that start to come back in and normalize this week as people are puking again out of some of the Mag 7, et cetera, and into Unmag 493 and others that we've been talking about. Now, that in mind, which we cover each week, this time of the year has a tendency to be a little choppy. That's going to be mostly reflected in the S&P, which is basically a Mag 7 ETF nowadays, given the weighting. So those names will continue to see chop. And I do think we're going to see the names like Baxter's moving, some of the defensive, Diageo, Estee Lauder, they're all starting to move because they do great in periods like this. So that's what we're focused on and positioned for. Southbound buying hits record in Hong Kong. So people are now panic buying into China. That game hasn't even begun. We're super excited about that. By the end of the week, 90% of corporates will be out of their blackout window, which means they can be in the market buying stock. August is the busiest month for repurchases. S&P 500 year-over-year earnings growth. You can see here in Q3 and Q4 drops off and then reaccelerates in 2026. So we'll keep an eye on that. Retail sales continue to be strong. The consumer's confidence, they continue to tell you that they're depressed and they want to jump off a bridge. But on the way to the bridge, they stop off at Home Depot and Walmart and all these other places and buy. So watch what they do, not what they say. 88 central bank cuts year to date, fastest cut cycle since 2020. So while Powell is dithering and doing what he does, the rest of the world is cutting, and that's why the rest of the world equity outperformance has been over 1,000 basis points over the US, because they're all lowering rates, increasing margins for their companies, giving them a competitive advantage, the global central banks, while Powell continues to keep his foot on the brake, even though we're in fifth gear, and put us at a competitive disadvantage. So this next lady will be kicked out, most likely, which will create a fourth dissenting voice on the board of governors, which will be the all-time high in dissent against the acting Fed chair, i.e. lame duck or Rama. Next, it better be different this time. Price to book value ratio, you can see in 2000, it was at 5 times. Now it's at 5.3 times. This is an extreme. Now, you're going to get the wise guys that are going to say, well, book value is not an accurate measure because all these businesses are asset light now. And there's some truth to that. But look, when you get to 3 standard deviations above the mean, you account for all that. It's crazy town, and we're seeing the signs of the reckoning and the resolution of that, and we're positioned for it. Percentage chance of a September cut still high, 80 some 5 some percent. New single family homes for sale. Supply is coming online. We're going to see more, and we're seeing that start to pressure prices. That's kind of in line with what our thesis has been. Foreign holders of U.S. treasuries starting to re-accelerate. Levered long versus inverse ETF assets under management. So you are seeing some, again, over concentration, over exuberance toward those 7 stocks, and just as they're starting to get distributed. Cyclicals versus defensive performance, best since great financial crisis. So we're starting to see that huge acceleration. That's why we're seeing it in the P&L and performance. So again, position for that. This chart keeps us up at night. This is from Strategas. It says the sum of S&P 500 defensive sector weights, consumer. So you're seeing an extreme of defensives weightings being below the 2000 trough in 21.6. So just to put it in context, what does it mean? It means in 2000, there was a cover of, I think it was Forbes, Buffett on the cover. Has Buffett lost his touch? Because everyone was bidding up the Palantirs of the day, i.e. Cisco and other companies, Amazon, all of which lost 90% of their value over the next 36 months, despite improving fundamentals of the business, particularly in the case of Amazon. So they weren't bad businesses. They were just overpriced. They were pricing everything that could go right for the next 20 years was already priced in, like we're seeing with some of the other stocks that are part of those weights. And so Buffett was buying, consumer defensive stocks, staples, Coca-Cola, boring businesses like of that ilk. And over the next 3 years, while the S&P was down 50%, NASDAQ was down, again, because it was all weighted in the high-flying stocks. NASDAQ was down, 80, 90%. Buffett had among his best 3 years ever. I think it was up like 50% a year. So this rubber band is stretched. We will benefit from the reversion to the mean. And in the meantime, what's so great is we're buying with such a margin of safety, even though the tailwinds of equal weight versus cap weight haven't fully slingshotted yet. The names we're in on a discrete basis are doing well because they're just such great bargains with such improving fundamentals that even X the tailwinds that are coming like a tidal wave in coming, I'll say years, but I think it's much sooner, months. The simple message that I'm saying is, if you think it's exciting what's been happening year to date, wait till you see when we actually get what Charlie Munger calls the Lollapalooza, and we ride the wave on top of it, and then everyone panics into our point of view. It's exciting time. So anyway, U.S. M&A transaction fees see uptick. We've talked about this, animal spirits. S&P has outperformed equal weight since 2015. We saw this in the late 90s, and then it was a complete fall off the cliff after that. Same theme. Industry average transaction price versus industry average incentive as a percentage of average total price. So total prices have stopped going up. Incentives have started to reaccelerate. That's all good for Cooper Standard. And that's why you're seeing the Stiefels of the world get on the train. And kudos to Stiefel. Better late than never, sure. But at the same time, they're going to be early in terms of the sell side. You're going to see more and more sell side people jump on at 50, more jump on at 80. And then they'll all be on board after 100, in our opinion. Again, all this opinion, not advice. When you go to buy your hat and shirt and all that stuff, go to terms at hedgefundtips.com. This is all opinion, not advice. Talk to your psychic, your financial advisor, your spiritual guru before you do anything at all. China's stock rally has the makings of a durable bull run, you think. Just getting started, ladies and gentlemen. Mainland Chinese investors buy record amount of Hong Kong stocks. That was part of our thesis. This hasn't even begun. Trump will do a deal. They'll shake hands. Baba's earnings are coming out, I think tomorrow, which is exciting, and so on. So this is early days. China stock rally sends Shanghai benchmark to decade high. It's mind-boggling to see the amount of what we're able to do before even Alibaba starts to go. I mean, yes, it's double up off the bottom. Yes, we brought the basis down to the low 80s. Yes, all that's great, but like relative to where it's going, it hasn't begun. Funds with $600 billion turned less bearish on China, survey shows. Again, opinion follows trend, ladies and gentlemen. China steps up tax crackdown on overseas investment. Wealthy individuals are rethinking trading strategy as Beijing tries to fill its coffers. So in other words, they're saying, that money is not going abroad. It's going into China companies. How you doing, Alibaba? Why 2025 is the year to invest in international stocks? You know, that was our pound the table in Q4 of 2024. They're a little late to the message, but early to the theme. So, and they just do it quantifiably here. That's not a word. Oh, that's not by Susan Dubinsky. She's probably the best person at Morgan Stanley, at Morningstar, by the way. No investment strategy works forever, not even for the Mag 7. So they're talking about the unwind of that trade, some data behind it over at Barron's. Jacob Sonnenschein over there. Money's rotating away from big tech. That's a good sign. Agreed. It shows sign of healthy market. And Brad Jacobs, here we go. A bet on QXO stock is a bet on this billionaire. Why it's time to buy. Early days in this story as well. Super excited to meet with him in late September. And we love this housing theme. We love this guy's made more money for shareholders than any other CEO in history, I think, on a repeated basis. Absolutely excited for early days in QXO and the housing recovery. Okay, somehow I skipped out of data. So, all right, and got into articles. So, S&P firms enjoy best season in about 4 years, with the earnings share of firms beating earnings estimates is the highest since Q3 2021. Foreigners start to return. U.S. existing home purchases by foreign buyers is ticking back up. That's a function of the dollar. For those of you who were in New York in like 2004 to 2007, like the housing market in New York was booming. And the reason is the euro at that point was at like 165 or got up to 165. So all of this European money was coming in and buying US real estate. That's also going to be a tailwind for housing as we see more and more, like, while it will appear expensive to American buyers, foreign buyers, as the euro, the CAD, or the loonie, and other currencies appreciate against the US dollar, you're going to start to see that foreign money start to flock in to US real estate. European small caps have lagged euro strength. So this, again, short-term voting machine, long-term weighing machine, it will catch up. Small caps are normally cheap. This is now US, going all the way back to 2009. Huge time to buy. This is European. Okay, European small caps relative PE to larger peers. So same story in the US. Here's S&P 500 equal weight versus S&P, which is basically Mag 7 to Unmag 493. And you can see there hasn't been an opportunity like this since the great financial crisis lows, which is exciting. Small caps starting to break out here. This is what they call like a cup and handle type of thing. Small caps versus large caps, best opportunity since 2000. Look, here's what's really exciting about this, and I continue to reemphasize, when I say generational opportunities, I'm not being hyperbolic. Okay, if you're a 48-year-old hedge fund manager or investment manager, okay, you are not going to get a better opportunity to buy small caps than you have right now for another 20 years, most likely. We have not, 25 years. We have not seen this type of opportunity to buy small caps relative to large caps since the early 2000s. Okay, that's generational. The next time I will have this type of opportunity to get rich in small caps, or let's be honest, richer because of small caps, is going to probably be 20, 25 years from now. So, I'll be 75 by then. Hopefully I'll be a 3 handicap. And my guess is probably working just as hard as I do now, because doers do. That's the bottom line. I see it over and over. It just, doers do. They think they're going to retire, and then they don't. And, they just like winning. They like playing the game to the best of their ability. And it's not about money. It's about quality work. It's about fulfillment. It's about, I had a mentor in my 20s named Jim Rohn. And he had a saying that he said, if you don't produce, you won't be happy, period. Okay? You can buy the jets, you can buy the boats, you can buy the houses, you can buy all that stuff. All that means is you just have to hire more people to take care of it. It's not going to make you happy. What's going to make you happy is production. And production is adding value to other people. You don't get abnormal compensation if you don't provide abnormal value. That's the way it goes. And it's very hard not to be fulfilled if you're providing abnormally good value to other people. And that's probably my best message for all the young people that are like, how do I make the most money in the shortest amount of time and all that bull? Your question is wrong. How do I provide the most amount of value in a reasonable amount of time, and the money will take care of itself? Okay, so just print this little chart out, get it tattooed on your back, and cash in. Okay, put it on your refrigerator. We don't do tattoos in my house, so cut it out, post it on your refrigerator with a magnet next to the test scores. All right, here's Baba's share count, ladies and gentlemen. What's happened? It's absolutely collapsed. That's a good thing. Why? Because you now own, give or take, 20% more of the company today than you would have, 2 years ago, with no additional money out of pocket. Okay. Small cap versus large cap. We may have seen peak negativity for small caps, you think. Prime book versus US long short ratio getting a little, they're starting to chase up. And what are they chasing up? They're basically chasing a Mag 7 index, and maybe they don't know it, maybe they do know it, but that's fundamentally what they're doing, whether they know it or they don't know it. Dumbo. Okay. The Hill. Companies have invested billions into AI, 95% getting zero return. That's all you need to know about the Mag 7 trade. It is pricing in everything going right for the next 20 years. And you know what's going to happen? Everything that they promise is going to happen, and probably more. AI is probably going to be better than we think it's going to be, if it doesn't kill us first. But let's just assume we're going to live, and in which case it's going to be better than any of us could imagine. The problem is that's already priced in, ladies and gentlemen. And with some of the companies, it's more than priced in. So when they do 1% less than expectations, they don't fall 1%, they fall 75%. And I'm not predicting that, because I think a lot of them just need to really consolidate the gains for a while. But some will, and that's it. When you have expenses going up and returns on those, or capex going up dramatically and returns on capex declining precipitously, like we talk about earnings growth of the Mag 7 down from 33. This quarter is going to be the first quarter where it's going to be somewhere at or below 10%, down from 33% just a year ago, and the multiples haven't yet contracted. Like, come on, ladies and gentlemen, do the math. Short-term voting machine, long-term weighing machine, reversion to the mean. This is not rocket science. I mean, I look at, some of my kids' math stuff, like they were doing this factor absolute stuff, little embarrassing. I forgot some of it. I mean, it's like 13. I could do, you can give me like 60 numbers and add, multiply, divide. I could do it all in my head in 2 seconds. But anyway, we're looking for a tutor. So let's just leave it at that. Meta freezes AI hiring, and they actually started firing people in their AI group. Tells you everything you need to know. Meta Platforms paused hiring AI division after bringing on more than 50 researchers and engineers. Wall Street Journal reported on Wednesday. Percentage of S&P companies with positive 3-month percentage changes in forward earnings going up. Revisions are going up, ladies and gentlemen. That's partially why the market is holding up. Consensus forward PE valuation, you can see here, relative to 10 and 30-year history, absolute PE, what looks cheap, real estate, which is going to be a rate play, financials, not in that group. So real estate, healthcare, energy, we continue to like and own. Comstock Resources, obviously from much lower levels. People are getting faked out because you get just short-term noise about supply and demand, about natural gas. This is a secular play. If you need to make money in the next 6 months, I have no effing idea where Comstock Resources is going to be. In 3 years, it's going to be a lot higher. So for those of you who are in the 6-month game, wrong podcast. Go find some guy with moving 30-minute charts that has a big run for 6 months and then his channel disappears because he's applying for jobs at Walmart. So healthcare, same story. Healthcare, I mean, other than pounding the table on China and small caps and value, I think healthcare is probably the biggest table pounder. We have a basket of Biotech, and we have Baxter, which is a pretty solid amount for an 8 to 12 stock portfolio. But we're open-minded to have more. But we got to have enough room for our small caps, like our Comstocks and our Cooper Standards and our, Gooses and stuff like that. All right, MSCI valuation and our VF Corps, baby. How you doing, VF Corp? We love you. All right. MSCI China valuation multiple, again, trading around 10 times, 11 times relative to the US, and earnings growth accelerating versus the US. It's a no-brainer. Our equal weight versus. So I continue to try to find. It's kind of like Jesus with his parables. He kept saying the same message. He just used different stories, hoping that it would hit people in different ways so they'd understand the lesson. And that's what I'm trying to do with these pictures and these stories, is keep saying the same thing in a different way so it hits, and you internalize it, and you go on and make a fortune, and maybe you throw a few bones to Great Hill Capital so we can accelerate it a little more quickly for you. Healthcare seasonal patterns tends to be weak this time of year, accelerates into year end. That's a good thing. M&A ticking up, animal spirits, equities, premium valuations leave little room for error. And that's when you talk about tech, when you talk about equal weighted, it's really, really inexpensive. When you look all the way down the spectrum to Euro, emerging markets, China, and Hang Seng, the opportunities of the century right here. Pagada atención, as my daughter would say after listening to Duolingo, for those of you who are asking about that stock. They make them do, it's kind of funny, they make them do Duolingo in Spanish class. It's like, well, then why am I sending them to school? They were doing Duolingo when they were homeschooling. Anyway, Wall Street forecast revert back from tariff turmoil. So opinion follows trends. They're all taking up their price targets. U.S. real GDP, you can see the trend's going to be a little weaker in Q3. 1% real GDP and a Fed that's belligerent makes no sense. Monthly insider selling picking up. You know, this is interesting. You got your winners like Brad Jacobs buying GXO at $33 hand over fist. And Baba, who was buying stock hand over fist in the 60s, 70s, and 80s. And then you got the other companies, the high-flying tech companies, buying at all-time record valuations. And you can see the insiders selling into that liquidity that they're creating, with you being the bag holder. Pagar atención, ladies and gentlemen. Unemployment rate ticking up. This is for, I think this is for the young kids, if I'm not mistaken. NFIB, single most important problem, percent reporting poor sales. I don't know. What I can tell you is this chart looks like another chart I saw, which shows unemployment among young people actually, 8 or 10%. The kids getting out of college, not good. Powell needs to pagar atención. China stocks close at highest level since 2015. Early days. This is just going to start breaking out for all of those folks that love breakouts. Welcome to the party. After we're up double, you guys can join the party for another double. Neil Sethi, Fed funds to 10-year yield spread remains slightly negative this week, continuing to call for at least 1%, one full percentage in rate cuts, with it well under the typical spread, about 1 to 1.25. Visa spending momentum index way up. Watch what they do, not what they say. Stocks versus bonds, Jackson Hole moved 2% on average. So look, I'm not expecting miracles from this guy tomorrow. He tends to be a wet blanket. I think he's not going to be dovish until the day after he cuts. I mean, that's really what it comes down to. He'll be hawkish until he isn't. And my guess is September's a go. If we get bad labor numbers, it's 50 bips. More likely, it's going to be 25 bips. And we'll lame duck him till the end of May. I've never, I just can't imagine being in a job where everyone's trying to push you out and you're staying, and, being ineffectual and still wanting to stay for the free coffee. I mean, here's an accomplished, amazing business person who's just in the wrong job. I mean, he would have been probably a world-class treasury secretary, negotiating deals and running the treasury and doing great things. It's just, he just got the wrong position. Money market fund assets, we covered this. They'll come down as rates come down. Cyclicals versus defensive breaking out. Earnings revisions going up. Russell outperforming the S&P in the last 3 months, and the last 1 month, and the last 6 months, and the last 12. Is this correct? Oh, okay. 3 months, 6 months. Yeah. So it's the trend is changing. S&P top 10 weights is 40%. The net income, I think, is 24%. So again, huge divergence that will correct. Home prices fell in a record 39 major U.S. metros in July. Pagar atención, ladies and gentlemen. Magnificent Seven. Okay, this is the most important chart that I've been talking about. Magnificent Seven stocks, S&P index weight versus the share of S&P 500 net income as of August 15th, 2025. So 32% of the index weight and only 26% of the net income or the earnings power of the S&P 500. So earnings growth decelerating, multiple still elevated, and one of two things has to happen. Either earnings growth has to reaccelerate rapidamente, or the multiple will start to contract, and I think it's the latter for those stocks. China Internet ETF, that's KWeb, my friend Brendan Ahern runs, just beginning the breakout. We are at, if you remember, the Mamis cycle, stock market cycle. Big reminder here. I had a new client come in at the normal, the $5 million level today. They can come in mid a quarter. And he was telling me how he ran successful businesses in China. And he said, I know China's moved a lot from your basis. But I really think it's just getting started based on my contacts over there and everything else. And I know you don't like to buy things up, but I'd really like a heavyweight in BABA if that's possible. I was like, let me tell you something. New money coming in today will have a very, very heavy weight in BABA. There is no this has not even started. It has not even, we're not even, it's just percolating, ready. The ball is under the water, ready to explode. Why? We are right here, ladies and gentlemen. We are in this denial phase. What does this look like? Okay, let me show me what this looks like. What the hell does this look like, ladies and gentlemen? Does this look anything like this? And if you're listening, grateful, but I'm sorry for you because you're missing out from these images that will program into your brain so you'll see these patterns throughout the future. This is critical. We are right here. We're in this last phase of denial. We've already gotten through the hell of reversion. We're in this last phase of denial, and we are ready to go parabolic. Okay, and that's all I have to say. KWeb versus S&P just breaking out over this trend, the ratio chart. So good work on that. Here is healthcare relative to the S&P. Again, going back to 2000. This is a home run, generational, non-hyperbolic statement. I will have to wait 25 years to have this type of opportunity again in small caps and or healthcare. And by then, I'll probably still be working this hard, so I'll take advantage of it again. But all right, stock market around breath thrust. Here we are. You can see it happening. We talked about that when we were here. You guys have seen it. Guidance, F1 guidance, fiscal year guidance relative to previous guide is up. The penalties for missing the market's best days are stiff. This is 2009 to 2025. If you sold in the hole, so if you stuck with it, you compounded at mid-teens. If you sold in the hole and then bought back, you compounded at low single digits. And if you bought in the hole, you compounded at probably double what the S&P did, if not more. EV retail registration shares. So you can see Tesla's declining. I just bought my wife a new Tesla. We'll see. I mean, I'm not an EV guy, but she likes all that stuff. So whatever. New houses are now cheaper than existing homes. That's pretty interesting. So you're seeing incentives there, which is volumes, which helps home builders, which is the same thing we're going to see in Cooper Standard. Ratio of market value of the five biggest stocks to all small stocks combined. Again, extreme generational opportunity. Cumulative change. And by the way, if you think you're going to get a generational opportunity that happens once every 20, 25 years, and you're going to pin it down to the 3-day inflection point, you're a moron. Okay. These things take time to play out. And when they do, it's abrupt. So if you get the perfect bottom, congratulations, you're lucky. You flipped a coin and won. If you get close to the bottom and you add over time over, a 12-month period, and then when it goes for multi years, you make absolute generational fortunes. Okay. U.S. housing starts rise to 5-month high. Game is on for builders, ladies and gentlemen. Generac, Stanley's, QXOs, etc. CTA positioning in U.S. equities getting a little stretched. Those are those Mag 7 stocks. All right, so can I communicate this message any clearer, ladies and gentlemen? Here we go. What do we got here? Okay, small caps will rally into Labor Day week and then finish the year super strong. That's from Hirsch over at Stock Trader Almanac. Cap weight's breaking out. Equal weight just knocking up. They're going to break out. This is rear view mirror where the puck has been. This is windshield where the puck is going. Healthcare, energy, consumer discretionary. There's your opportunity. This is where everyone's crowding in. What's already happened. This is where you want to be going, where the puck is going. Flows by ETF category. Okay. Russell 2000 non-commercial futures position. Okay, commercials are always right. Large traders are always, i.e. hedge funds, are always wrong. Here's where they are. Record short, just like they were in the hole at the lows in 2022, just like they were at the lows in 2019 and 2018, and they missed it. And they'll miss it again, but you won't, because you are awesome, brilliant listeners of Hedge Fund Tips with Tom Hayes. Large cap pharma stock valuations, again, that's opportunity in healthcare. Renter households surge by 1.6 million in 2023. So everyone's saying this is now the new normal. I would say lower rates and let's find out. And I think that's what you're going to see. Wait till you see the interest-only 5-year ARM game back on and the 7-year ARM. Like you all forgot about that, and that's when it comes back. The minute that people have a short memory. The game is going to be on again, and people are going to say, what happened? And that's that. Strong expectations embedded in small caps. So here is earnings growth expectations for the S&P the next 12 months is like 12%. Russell at 45%. And one is trading at 16 times. One's trading at 22 times. You can't make it up. Benefit from those divergences. Long as retail weekly option buying streak on record. They're buying all the high flyers right before the rug gets pulled. Don't do that. Okay, initial jobless claims. Powell needs to pay attention to that. That's starting to skyrocket up. Long waits between cuts can be quite bullish. Year later, 12.9. That's from Carson. And that's the data. Okay, so now we did that. Did that, did that, did that, did that. U.S. housing starts rise to 5-month high led by multifamily. Okay, building supplies. Mortgage rates slip to lowest level of 2025. Bets on stable coins to bolster demand for treasuries. Been talking about that for 6 months. Foreign holdings of treasuries climbed to record high in June, the exact opposite of what people were prognosticating. SoftBank invests $2 billion in Intel as U.S. considers taking 10% stake in chipmaker. Okay, so what he said when he did it was something to the effect of Intel's going to be a major player in advanced chip manufacturing. This is Masayoshi-san, who likes taking cowboy bets on new trends. He was an early investor in Alibaba. And what did he say here? I guess the quote's not in here, but you can find the quote. So that's one thing that happened. The second thing that happened was US government going to take a stake. What they're doing is converting the committed grants that have not been received into equity, which is fine. I'd rather have the US government dilute me by 10% and be a committed partner, forcing all of the US chip designers to start to buy from Intel once they have proven their technology, and push them along to guarantee that their technology gets along the finish line with special loans, forcing people to become that big customer, that lip Bhutan. So this is an absolute home run. I pray it goes a little lower so I can get new clients a big position in this. And then having the government as a partner. Look, this is not, I said to a client who was having some concerns about some of the policy, I said, listen, we play the hand that we're dealt, not the hand that we want. And if we lose the ideology about what should be and deal with what is, we can outperform by maximizing that. And that's all we do here. This is about making money. This is not about being right about politics. We could care less about politics. We are in the money making business, okay? Period. I don't care if we have a Democrat. I don't care if we have a Republican. I don't care if we have a America First, whatever the hell it's going to be. I just want to know the priorities, and then I can adjust accordingly. And that's what we've been able to do, and do it exceptionally well, and are going to continue to do. So if the government is going to stand up Intel, I don't want to stand in their way, because I know what government standing up an industry can do. And I know what it did on the other side for Elon Musk. Would not exist if not for all hundreds of billions of dollars of government subsidies and tax credits that he was able to sell for cash over a decade plus, that stood up an industry that would be unsustainable on a standalone basis, and now is starting to sustain itself. So the same will be the case with the Intel fab business, and they're a monopoly because they're at the 10-yard line. No one else is even close. They have the history, so they got a little sideways, but they're the only game in town. That's been our thesis since day one, and now you're seeing it happen. Tomorrow's newspaper today, and people are surprised, but it's not surprising. There was not another choice. So, it's like when you take multiple choice tests, just eliminate the possibilities that can't be the answer, and you're left with the one thing that is correct, that is the answer, and that will be the case with Intel. Estee Lauder hires advisors to review brands and spur recovery, so these guys are turning around. Magic Force driving U.S. stocks to records. It's called earnings upgrades. Bank of America suggests the era of the biggest stocks dominating markets may be done. Energy super majors are betting big on LNG, shrugging off peak gas predictions. Crafting a comeback stock market and sentiment results. We got Advance Auto Parts and Etsy. So Advance is obviously up about double off its April bottom, just getting started. Let's take a look at what's happening here. You can go through all this on your own, but let's get to the key stuff, which is the 10 key points. Where are the 10 key points? Hidden in the 1,000 key points. Here they are. Number one, Advanced Auto Parts delivered $2.01 billion in revenues during the quarter, landing at the high end of prior guidance and beating consensus by $33 million. Most importantly, this was driven by positive comp sales of 0.1%, an improvement from a negative 0.6% in Q1, and also at the high end of guidance. Adjusted EPS came in well ahead of expectations at 69 cents versus the street's 54 cents. Two, management continues to deliver on the profitability front, returning the business to overall profitability in the quarter, with adjusted gross margins rising to 43.8%, up 16 basis points year on year. The most important metric in the turnaround, adjusted operating margins expanded to 3%, up 19 basis points year over year. For the full year, management continues to expect adjusted operating margins between 2 to 3%, with the company on track to reach its 7% target by fiscal year 2027. Not 2037, 2027, okay? Implying $630 million in EBIT. Okay, this is the most important sentence of the week. For the full year, management continues to expect adjusted operating margins between 2 to 3%, with the company on track to reach its 7% operating margin target by fiscal year 2027, implying $630 million in EBIT. For context, the last 3 times Advanced Auto Parts generated operating income in the $600 million range were 2018 when they did $617 million, 2019 when they did $679 million, and 2022 when they did $670 million. In those years, when the share count was higher than it is today, earnings per share came in at $5.75, $6.87, and $7.70, with the stock trading as high as $186, $182.60, and $244.50. The stock right now, ladies and gentlemen, is like $60. Okay, the upside is enormous on this. The market still doesn't buy this and continues to treat Advanced Auto Parts as a show me story, with consensus only pricing in 4.75% operating margins for 2027. That ignores the proven winner that is CEO Shane O'Kelly, whose track record at HD Supply speaks for itself. We will side with O'Kelly all day long and believe the market will eventually be forced to catch up. Number 3, the pro business. The pro business, the biggest business overall driver, they have got pro for professional guys who fix cars, and the DIY for the schmoes who change the battery in the parking lot, or, whatever. The people who know how to do that. My dad was one of those guys who would sit in the driveway on the weekends and change his brakes and change his oil and change his battery. And, kudos if you have the skills to do that. I can't even, whatever. All right. The biggest overall driver of AAP's underlying performance continues to show strength, with positive comp growth in the low single digits during the quarter and mid-single digit growth on a 2-year basis. Pro customers are showing increased confidence in AAP, as evidenced by sustained sales growth from both Main Street Pro accounts and large national customers. Number 4, while still early in turning around the DIY side of the business, management remains encouraged by emerging signs of stabilization in the segment, with Q2 DIY comp sales stable compared to Q1, and on a 2-year basis showing improvement. Management has not yet seen any significant shifts in consumer spending, as the quarter ended on a strong note, with DIY delivering positive results that beat momentum, carrying into the first 4 weeks of Q3. 5, the supply chain transformation continues to run ahead of schedule. Management has already closed or converted 9 distribution centers this year, and remains on track to finish with 16, down from the inefficiently run 38 prior to the program start. The other key driver of the transformation is market hubs, which stock 75,000 to 85,000 SKUs and provide same-day parts availability for up to 90 stores. Management is on track to open 10 hubs this year and reach 60 by mid-2027. Most importantly, stores served by the new hub strategy continue to see an average comp sales uplift of 100 basis points, which management believes has the potential to drive even stronger sales growth over the long run. 6, management continues to work on tariff mitigation strategies while prioritizing profit dollar expansion, with 40% of COGS exposed to tariffs at a blended rate of 30%. Most importantly, more than 90% of AAP's business remains non-discretionary, keeping the company well positioned to navigate a higher product cost environment. 7, management is making great progress on the merchandising front, completing 2/3 of the product line reviews and expecting to finish over the next few months, which should deliver 50 basis points of annualized cost reductions beginning in the second half. This process has also enabled AAP to add more than 60,000 new SKUs to the network, nearly tripling from last year, and improve the key store availability KPI to the mid 90s%, up 100 basis points from Q1 and from the low 90s% in the same period last year. At the same time, the company's continued rolling out its new assortment framework, now live in the top 30 DMAs and on track to be completed across the top 50 DMAs, 70% of sales by the end of Q3, well ahead of the original 12 to 18 month time frame that extended into 2026. Most importantly, the framework continues to deliver an average comp uplift of 50 basis points. 8, during the quarter, management proactively reorganized the debt capital structure, completing a $1.95 billion senior note offering split into 2 equal tranches maturing in 2030 and 2033. They also entered a new $1 billion asset-backed revolving credit facility to replace the prior $1 billion revolver. The additional liquidity provides flexibility for the supply chain financing program, and management views the reorganization as a bridge to reattain investment-grade credit rating, a material unlock for the business. 9, management continues to allocate substantial capex to refresh the store footprint, already investing 3 times more maintenance and capex than in all of 2024. The spending has been applied to more than 1,000 stores as part of a multi-year plan to enhance the in-store experience for both customers and store teams. For context, the previous model relied on a break-fix approach for many years, with 80% of the HVAC systems beyond useful life, over 50% of roofs aging out, and more than half of parking lots in need of replacement. Number 10, for full year guidance, management reiterated net sales of $8.4 to $8.6 billion, comp store sales up 50 to 150 basis points, and adjusted operating margins of 2 to 3%. Management did, however, adjust EPS guidance to reflect the higher interest expense from recent debt offering, bringing the target range to $1.20 to $2.20 per share versus the prior $1.50 to $2.50. Free cash flow is still expected to be negative $85 million to negative $25 million, reflected a positive operating cash flow through the end of year, offset by $150 million in cash expenses related to the store optimization project. On to Etsy, and we went through the call. You can go through our highlighted points at hedgefundtips.com. Scroll down to popular articles. It'll be in the number 1 post. Etsy update. Look at this beautiful free cash flow cash machine, record cash flow, record high cash flow, record low price. That will converge very soon. Revenue's still climbing for the most part, and a good turnaround plan or reacceleration plan in place. Let's go through the top 10 points. Number 1, Etsy reported Q2 revenue of $673 million, up 3.8% year on year and $25 million above consensus. The upside was largely driven by a significantly higher take rate of 24%, expanding over 200 basis points year over year and exceeding prior guidance, supported by a 15.3% year on year increase in seller services revenue. For Q3, management expects further take rate growth, guiding to 24.5% for the quarter. Number 2, consolidated gross merchandise sales for the quarter came in at $2.8 billion, down 4.8% year on year, but showing a sequential improvement versus Q1's 6.5% decline and outperforming prior guidance that had anticipated a similar drop to Q1. Excluding Reverb, Q2 gross merchandise sales was $2.7 billion, down just 2.6% year on year, compared to a 6.2% decline in Q1 on the same basis. Stabilizing the core Etsy marketplace remains the top priority, with gross merchandise sales trends improving 350 basis points sequentially and posting positive year-on-year comps in both May and June. 3, Depop continues to post strong results with GMS of $250 million during the quarter, up 35.3% year on year and reaching an annualized run rate of $1 billion in GMS for the first time ever. Growth was led by a 54% increase in the US, making Depop the fastest growing player in large online fashion resale market by a wide margin. Management believes the company has a significant runway, with overall awareness remaining low and plans for accelerated investment in the marketplace in the back half of the year. 4, management views the Etsy app as the key driver of the overall flywheel, with app users showing significantly higher lifetime value, stronger loyalty, higher retention rates, and greater GMS per buyer. App GMS once again outpaced non-app GMS during Q2 and now represents 45% of total GMS, up more than 300 basis points year on year. Download rates remain strong, and monthly active users are up 7% compared to last year. 5, management continues to refine its marketing approach, shifting spending away from linear TV towards higher ROI channels and personalization. Consolidated marketing spend rose 16% year on year to 212 million, including a nearly 50% sequential increase in creator and influencer programs. Most importantly, the ramped up spend is translating into results. Q2 GMS from owned marketing channels, email, push notifications grew 33% year on year. Personalization now accounts for 40% of messages versus 27% in Q4 2024, driving higher conversion, visits, and GMS, with management expecting near total personalization by year end. 6. During Q2, management reactivated 6.5 million buyers, up 2.8% year on year. New buyers totaled 4.8 million, down 14.5% year on year, while trailing 12-month habitual buyers reached 6.1 million at quarter end, down 12.2% year on year. Active seller count remained flat sequentially at 5.4 million, but the new seller startup fees has proven successful, with a higher percentage of current active sellers making a sale in the past 12 months and an improvement in the number of new sellers completing a sale year on year during Q2. 7. Management repurchased a total of 335 million worth of shares during the quarter at an average price of 52.34, reducing the share count by 6.4 million. Another smart buyer back of stock, buying at the lows, issuing at the highs. When we get into the mid hundreds, they will probably be sellers, certainly not buyers. 8. Free cash flow generated during the quarter totaled 90 million, a conversion rate of 82% of adjusted EBITDA on a trailing 12-month base, bringing the TTM free cash flow to 635 million, implying a free cash flow yield of 10%. Management continues to expect healthy free cash flow for the full year, thanks to an asset-light business model supported by a sound balance sheet with $1.5 billion of cash and just $3 billion in convertible debt, including the $700 million issued in June. 9. On June 2nd, management completed the $105 million all-cash sale of Reverb, the music marketplace acquired in 2019 for $275 million. The deal resulted in a $102 million impairment charge, but the business had long been a drag on growth and profitability with limited room for improvement. Management was happy to exit valuing the business at a mid-teens EBITDA multiple. And 10, management noted continued strength in consumer spending across all cohorts with no major impact from tariffs or trade announcements. Spending stabilized in May and June and it has held steady, giving management confidence to guide further improvement in Q3. Consolidated GMS is expected at 2.6 to 2.7 billion, with the midpoint implying sequential growth acceleration, a 24.5% take rate, and a 25% adjusted EBITDA margin. So go through the earnings call and our highlights at your leisure. Moving on to earnings. Biotech, equal weight, XBI, top 30 weights, updated revisions, earnings updated to 8.06% earnings growth for 2025. 2026 estimates went up by 5.01%. So inflection in biotech earnings estimates going up. This game is just getting started as well. IBB biotech earnings, top 30 weights, same story, up 9.02% for this year. In the past 60 days, earnings were revised up 6.14% for 2026 in the last 30 days. Housing starts are good. Continuing claims came in, initial jobless claims came in higher than expected. Dual mandate. They need to be focused on. Now, on to the incredible Ask Me Anything questions. For those of you who like to this part of it, stick around. You're going to learn some great stuff. Those of you who just like the podcast, we'll see you next week we'll be in New York. Busy week in New York. Playing in the beer league flight at my Connecticut club of the club championship. So wish me luck. I've been kind of spotty. I mean, really up and down the last couple of weeks. Couple 9 handles on 18s and a couple 3 handles on 9s. So it's all putting. Anyway, it is what it is. All right. Thoughts on Target. This is from Aaron Oda. Yeah, the market didn't like the fact that they brought in an insider. I mean, I think Target would probably double if they brought in that girl who did the American Eagle, Sydney Sweeney. I kind of like it here. I got to be honest. What is that? $96. God, if I could get it with an 8 handle again, I might actually even make it a position. But I'm not in a big rush to do that. But on balance, I think it's going to be okay. There is pressure, obviously, from Walmart and Amazon and everyone else, but I still think they have something unique. Not a great business, but at this price, it's not a bad business either. Lee Foster, what do you think about Bruker BBKR? I'm getting a lot of questions on this. There must be someone pushing it online. Let's see about Bruker. That's not the ticker, I don't think. B-R-U-K-E-R. B-R-K-R. B-R-K-R. All right, revenue's okay. Cash flow and margins decelerating. What do these guys do? Scientific instruments. Yeah, medical devices. Which reminds me of Illumina. It just depends how much of their sales. Let's see. 194 million in cash. $2 billion of debt. That's a lot of debt. They must have done a deal here. Their cash is not. They have a lot of receivables. All right. I'm not in love with this balance sheet. I got to be honest with you. Share count stable. Revenues are okay. Look, I think you'd probably be okay with this, but you better understand the moat of their products, because if there's a new entrant, this could be a real problem. On a superficial analysis, I would say there's enough here to start to do real work on it. Instinct, probably higher and better uses of capital, but you're probably in the ballpark. So you got to listen to the last 8 calls, start to read the public filings, start to read sell-side research, start to do channel checks, understand the competitive environment and what's unique about what they offer. Otherwise, it's just a race to the bottom. But generally, probably okay. So good question. Nate Mariner. Thanks for everything you do. Recommended hedge fund tips to my mother who's getting into managing her investments. Thank you for that. What do you think about Illumina? This is the one that Carl Icahn got bagged in and wound up puking out in the hole. So I don't know. I think he got out for a reason, but this was a loser for him for sure. Revenues have been flat. Looks like free cash flow is recovering a little bit. Yeah, I think it's going to be the same story as Bruker. You better know the product inside out and upside down and make sure that there's a moat there. Balance sheet looks Share count's okay. $1.4 billion. Yeah. Cash flow's okay. I think it's worth starting work on, but it falls into the healthcare theme. But you again, this is not like, oh, the chart looks good and the balance sheet's okay, therefore buy it. That's like, no. Now the 99% of the work starts, and you're not looking to confirm your idea that it's a buy. You're looking to disprove your idea that it's a buy. And if you can't come up with any salient reasons not to buy it, then maybe you consider doing a position. It's always invert in investing, because if you're just dealing from confirmation bias, you're always going to lose. So, try to find 10 reasons not to buy it. And if you fail in that task, then you might have something. Okay, regular listener, this from Marcel Bala. Interesting, new to learn. Regular listener, always find something interesting, new to learn. So kind of look as team viewer. Huh. What do they do? Remote connectivity solutions. I mean, the issue here is me too. This is in the software category. The question is this going to get disintermediated? I have no idea. Right now it looks great. Tomorrow it could be worth zero. Just generally, I mean, unless the margin of safety is so great, I'm generally not chomping at the bit to buy cheap software stocks just yet. So they've got 300 million of debt, 50 million of cash. Sales are growing. Share content. Look, from a financial standpoint, this thing warrants doing some serious work. But you better be damn sure that the moat is impenetrable, and I can't just give someone $1 billion to replicate it and put them out of business. That's the problem with software companies, which is why Buffett never did software. But financially, looks great. I mean, good work. But now the work begins. So thanks for all the value you share. This is from Paul Manji. Question, you mentioned running 8 to 10 stocks. So what we do is when new money comes in, we put them in the best. The reason we run in separately managed accounts is because we want to put new clients in those stocks that are just leaving the station, not already cruising at 30,000 feet. So each portfolio is going to have, 8 to 12 stocks, concentrated portfolio, but we're not putting them in, Cooper Standard at $35 after it's, moved up from $5 where we initially bought it. The existing clients are going to hold it and ride it, but we're not going to put new clients in those. We're going to put them in the ones that are just getting going, like VF Corp, to a lesser extent, Baba's come off a lot off the bottom, but that would be a position. Intel, if we can get it a little lower because it's moved up recently, things that are just getting going, a concentrated portfolio. So yeah, there's going to be a universe that's a little bigger than 8 to 12, but they're going to converge over time. And I think we've done a really incredible job by doing it that way. Versus a commingled fund, all the money comes in after you've had a huge move, and then the new people are getting in after everyone else is up 70%. not ideal, okay? And then you're always going to get a 10 to 15% pullback after a huge run like that. But with SMAs, we can put them in those things that are just getting going so that they can have the next huge run in their concentrated portfolio. So pretty good question. Thanks for tuning in. Eric B, could you look at Pitney Bowes? No, we look at it every week and we continue to pass. Not for us. I know it's in a value trap. Everyone's crazy about it. It's not for us. Paul M, thanks for all you do. I'm hoping everyone shares your pod with friends as much as I do, so you keep doing this forever. Thank you. Could you please let me know your thoughts on XPEV? We're not buying any Chinese stocks other than Alibaba. And as far as the race to the bottom, some of those, gamble and win, pick NEO, maybe pick NEO, pick XPEV, pick 3 other BYD. One of them you'll get a home run, the rest won't. That's just gambling. It's not for me. I never want to be in the auto manufacturing business. I want to be in the arms dealer business like Cooper Standard. Abhishek Gupta, been applying your way of looking at companies. Could you let me know your thinking on Consensus Cloud Solutions, CCSI? Revenues have not moved in 3 years. Neither have margins. Looks okay. Let me take a look. Information delivery, software as a service. Again, they have eFax, MyFax, MetroFax. I mean, I don't know. This is not the type of business that I would be interested in. I mean, tell me why and how their moat is going to be durable. Again, this is software. Yes, it looks cheap, and yes, it may. The fear over AI may pass soon as people realize that it's not going to do everything for you. But this looks like a runoff business with revenue so flat. And given that they're doing MyFax and eFax, it probably is a runoff business. Just people who have the subscription and forgot that they do because they no longer need it. And I'm sure they do some other things. But what's the moat, and how do they reaccelerate growth with all this cash? Let's see, 350 million of cash. They probably have 0 debt. Well, hold on for a sec. $500 million of debt, 34 million in cash. Sold to you. Not interested. Let's move on. Jimmy Jones. Professor Tom, if Baba reaches his intrinsic value, would you still sell it before the Ant IPO or wait? Yeah, I would sell it. If it's already pricing in all the good that I expect, I'm going to sell it. But we're nowhere remotely even in the zip code of being ready to do that anytime soon. Can you look at ATRO? My guess is the Ant IPO will come sooner than any price that's more than double from these levels. ATRO. This is from Roger Bustamante from Puerto Rico. All right, love it. I got some friends in Puerto Rico. Actually, a few friends. One you heard from a couple of weeks ago, and a couple others that are coming in as very, very big clients. So we're excited for that. Found this on Twitter. Backlog. All right. It's already had a run. Roger, why weren't you giving this to me at $8? Why are you giving it to me at $37? It's already up 4x. Now, is it going higher? Probably. But we prefer things when no one wants them. The fact that it's up 4x in a handful of months is because people are starting to want it. It's just inflecting, and the price started to sniff that out ahead of time. So, yeah, it probably goes higher, but no, I wouldn't be a buyer right now, even though it'll probably go higher. Yeah, good idea. Not the best time. Theo Dujardin. Thanks for all you do. Blah, blah, blah. You're welcome, by the way. Very grateful. Also, great work on the interview with Growth Darrow and the coaching you give to young and aspiring students. My hat's off. Thank you very much. Appreciate that. All right. So he's asking all these complicated questions about Cooper Standard. Oh, this is from Portugal, by the way. Very nice. Dujardin sounds French. Yeah, so these are all short-term questions. This is a secular play that will be out of in 3 or 4 years unless it hits intrinsic value sooner. I don't care about the short-term volatility. This is another one I'd be a buyer with new money right now, even though our basis is much lower. So thank you for all the kind words, and ignore the short-term noise. Crota International, this is from Robert Davis. Yeah, this is a broken growth stock. So CR. Yeah, this thing hurt a lot of people. It's going to take a long time to build a new shareholder base. They just continue, their return on invested capital is I'm sure well below their cost of capital. Not an ideal situation. Revenues just showing a small sign of recovery. Life science, fragrances and flavors. Oh, yeah, this is, it's been around since 1925. Yeah, this is like IFF. I think this group is ready to start to participate again, but $208 million in cash, 700 million. Yeah. They're increasing the share count a little bit. It's okay. Well, it's not okay, but it's not egregious. Beauty care, home care, fragrances and flavors, 1925. I mean, it is a durable business, but let me see, quarterly. hourly what's going on. This is not as much of a slam dunk as it looks like it is, Robert, but I think it does warrant doing some work. I would go listen to the last 8 conference calls. What did they say they were going to do? What have they done? What have they promised for the turnaround? What is happening? And try to find 10 reasons not to buy it. That's the whole goal. It's to figure out why not to get involved versus why to get involved. And then being perfectly okay if you miss it. Error of omission versus commission. I do like this chemical space though. So do the work. I think it's okay. I don't know that I'm going to do any work on this one, but I might. So if that's helpful to you, great. John Clark. PAGs, we cover this every day. Maybe you get lucky and you win. There's no transparency in those consumer finance portfolios, and you still have a bad hombre running the country. So hard pass for now. All right. Oh, Dujardin, you're trying to sneak in 2 questions in the back door. Don't know if I love this, my friend. But since you flattered me with the awesome work on growth, Daryl, looking forward to becoming a client because you've grown your portfolio. You buttered me up enough. Let's go. Bausch Health. This is one that John Paulson's been bagged in forever. I keep looking at it and I keep passing. I just think this is like your quintessential definition of a value trap that may eventually work, but revenues have been flat for 10 years. So now your bet is that they just keep buying in the shares because it's a runoff business. And that's not that exciting to me. Let's see if the numbers can prove me wrong. All right, so there's some acceleration. So find out what happened between 2023 and 2024. My guess is it's either new business or an acquisition, or if they figured out how to turn around the legacy business. Share count's kind of holding in there. 1 billion of cash. $20 billion of debt, hard pass. Not for me. On to the next. A lot of leverage there. If they don't go bankrupt, it's going to be incredible, but I pay more attention to the former part of the sentence than the latter. Maj Globusnik. Thoughts on Zimmer? Biotech? I think yes. Without even looking at it. This falls in the Baxter category, which is poised. I just don't think you have nearly as much upside. So I'm not even going to do a crazy thing, but I think you're right. Manny B. Portillo. Yeah, Mimi likes Portillo. There's so many in this space. Jack in the Box, Portillo's. What's going on with Portillo's? This is not a business I really like. Do we have any restaurants? Wow, what the hell? Big P&L today. Holy cow. Oh, Cooper Standard's up 17%. Oh my God. All right. Wow. Holy shit. All right. Here we go. Portillo's free cash flow negative. That's probably a financial issue here. Balance sheet. Revenues are growing. They're growing the share count too. I don't like that. Let's see. Yeah, look, I think with this 22 million of cash, how much debt do they have? 11. I think with this, you just have to, you gotta listen to the store, listen to the calls. Are the comp store sales going up or down? If they're going up, that means it's a good business model. Then you got to listen to how we're going to expand all over the country and what actions are they taking. Because if it's just regional, like I've only seen them in Chicago and Texas, and they're profitable on a store by store basis, and they're the comp store sales are growing, and they're going to expand, then you could have an unbelievable story like a Dunkin' Donuts. So I think this one's worth looking into, Manny. Let me put that down. PTLO. But I don't want to get stuck in a Del Taco or Sweet Green or all these lower end dog you know what businesses. Jack in the Box. I mean, that's garbage, but I think that one's going to work. Chris Williamson, Bruker. We already did it. Thanks for the question. Julio Flores. Thanks for the great listeners. Short-term. Yeah, Julio, look. He's saying, is it ahead of itself because they're not earning, $1.50 or $3 yet? No, because they're nowhere near cyclical peak volumes. If we were at 17.5 million of volume and the thing was earning, I think on 17 and a half, they're going to earn 10 this time around. And the stock was trading at, $200, so 20 times, then I would say, all right, we're fully valued here. I mean, at that point, the price targets would all go up to 300 and 350 and all that stuff. And we're probably closing out the whole position at that point. But this turnaround inflection is just getting started, and we're more focused on SAR than we are the short-term quarterly day-to-day. So no, I don't think it's fully ahead of. I mean, what I would say is incentives, volumes. That's early days. So leave it at that. John Salzber. Does your philosophy change when it comes to an IRA account? You won't touch till I feel like the best fad when it comes to them is buy some ETF. Well, look, I think you want to set and forget. So he's saying, like, I think in your IRA, it's a tax advantage account. So that's where you want to be in my view. This opinion, not advice. I think that's where you can be in individual stocks and options because you're not paying tax when you get out of it, whether it's in 3 years or 3 months. Whereas buying an index and sitting on it forever, you can do that in a taxable account because you're never selling it. So I would take advantage of the tax wrapper to have some of your more aggressive stuff, in my humble opinion. Again, talk to your psychic, financial advisor, everyone before you do anything. All right. GEHC, we covered that, Daniel, last week. Is this question from last week? Yeah, 7 days ago. So let's just quickly, maybe I didn't get to it last week. It's okay. It's not the one I want to play. So I'll leave it at that. Next, York. This is from 7 days ago. Yeah. So York, you're asking all these questions. Just get your CFA. And then you got to go through experience. Like, why did I know not to buy Lulu even though it was down? Why did I know when to get involved in CCI versus being too early? It's just a lot of experience. You just got to put in the years. And like I said, this business, it's like you'll make a lot more money starting a business in the short term, and if you're really successful in the long term. But in this business, if you can go 20 years and live to tell the story, you're going to make obscene amounts of money. That's all I can tell you, because by then you're really effing good. And you know, it's a very narrow group that can generate performance, and money flocks to it. So that's my best advice to a very long question. And congrats to you and your homies who tune in every single week. We're very excited to have you. Drew. Grateful for your thoughts on Celanese. CE is basically a balance sheet story. I kind of like the group. This one's a little more levered. Yeah, international fragrances and flavors. Got a strong eye on that one. A lot of insider buying lately. Durable long-term business. Haven't done anything with that either. Let's see. What do we got? Income statement here. Balance sheet is the issue with Celanese. They'll probably be fine. I mean, there's a lot of leverage in this with $10 billion of debt and $1 billion of cash. They're generating $500 million of free cash flow. What's the yeah, I would just pull up the entire cap table and find out how much is maturing at what years for the next 10 years and make a best probabilistic assessment based on rating and maturity and current financing costs and projected financing costs, whether you think if they're going to remain solvent, the stock is going to triple. If they're not, you got a problem. And I would bet on the former, that they are going to remain solvent and the stock is going to triple, but you have to burden yourself with the facts by doing the work. So good question, Drew, and thanks for all your support. And with that said, Al asks if I'm going to be in, I think I'm in Sarasota in December. Okay, and that's that. So with that said, we'll be back next week. Same time, different place. In the meantime, make it a great one. Bye for now.